Hey there folks, this is a new video. In this video we are going to talk about what are the best time frames to trade Forex currency pairs. Some of the traders have actually asked me they are not sure what is the best time frame to trade, whether they should trade on a 5-minute chart or a 15-minute chart or a 1-hour chart or a daily chart. So I just thought of making a short video to cover this particular important point. When we look at the time frame to trade, now different time frames have got a different set of characteristics. Based on those characteristics, they can be categorized into different buckets. So in this video, what we are going to cover is we are going to look at the different time frame categories. What are the characteristics of each time frame category? What is the best time frame in each category? And what are the important points to remember as well as mistakes to avoid? Okay, so there are three categories. If I look at the trading charts, there are three categories which come out. One is a lower time frame, which is for 1-minute chart, 5-minute chart, 15-minute chart, and so on. This is known as the time frame for day trading. And in this, the trades may last only for a few minutes or up to few hours, depending on the time frame. For example, if someone is trading on a 15-minute chart, the trade may last for let's say 2 or 3 hours. Whereas if someone is trading on a 5-minute chart, it may last only let's say 50 minutes or 55 minutes. So if you look here, this is a let me change it to 5-minute chart. In this, each candle basically represents 5 minutes. So for example, if someone has opened a trade here, the trade may continue for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And at the 11th candle, the person might decide to close the trade, so it lasts for only 55 minutes. The next is a medium duration time frame, where the time frame is 1 hour or 4 hour or 8 hour or even a daily chart. This is known as a swing trading time frame, where the trades may last a few hours to few days. For example, if someone is trading on a daily chart, the daily chart basically can last up to 7 days, 8 days, 10 days, or maybe up to 15 or 20 days. Whereas if someone is trading on, let's say, on 1-hour chart, the trade may be open for 15 hours to 20 hours to 24 hours, or maybe, let's say, 1.5 days. And then there are large time frames such as weekly chart or monthly chart. These are the charts which are used by big financial institutions. And here the trades may last a few days to weeks, or maybe sometimes even months. The reason this is typically being used by big financial institutions is because of the amount which is risked. Just to touch for a few seconds, when trading on a weekly chart or a monthly chart, the stop loss required is very high. On a monthly chart, the stop loss may be about, let's say, 2,000 to 3,000, maybe up to 10,000 pips. So that is some kind of amount which is available only at the big financial institution level. For average trader, they may not be able to put that much amount in a particular trade as risk. Now let's take a look at example or rather the characteristics of each time frame category. We are going to focus only on the small time frames, lower time frames, as well as the medium time frames, because the larger time frames of weekly or monthly chart, this is not something which is applicable to an average trader. So in the low time frame, the trade opportunities basically are available more or less every day, because you're looking at a lower time frame chart, let's say 5-minute chart or a 15-minute chart. A trade opportunity may come more or less every day, but it requires high concentration and quick response to open and close a trade. Basically, you cannot be away from the computer for let's say 1.5 hours, because if you do that, a trade opportunity may come and maybe you are not in front of a computer to basically open a trade. So it requires very high concentration and quick response to open and close trade. The profits are somewhere between 10 to 100 pips. For example, if you're trading on 1-minute chart, the traders trading on 1-minute chart can expect a profit of let's say 15 pips or 20 pips per trade, whereas the risks they may take is about 10 pips. There are only few hours when volatility is very high and trade opportunities are more present during this particular time frame. I'll cover that in the next slide. But the important point to remember is the currencies pair spread is very important. Now, if you look at the Euro USD currency pair, it has a spread of about 2 to 3 pips depending on the broker you go to. Whereas if you look at currency pair of, let's say, um, Euro franc, there the spread is about 6 to 7 pips depending on the trading broker. Now this becomes very important because the profit you're looking for from a particular trade is about, let's say, 25 to 30 pips. If your profit is, let's say, 30 pips, out of which 6 to 7 pips is a spread which goes to the broker, then your risk to reward ratio is significantly impacted. For example, if you have risk 15 to 20 pips and you're expecting a profit of 30 pips, all of a sudden because of the spread, you're expecting about profit of 23 pips. So in in such situations, it's better to trade on a day trading on a currency pair which has very tight spread, like typically Euro USD or USD British Pound, something similar. Now let's look at the medium time frame, which is swing trading. In swing trading, the trade opportunities is available only once in few days or few weeks. If, for example, you are trading on a daily chart, a trade opportunity may not be available every day. It may come in 4 to 5 days. Sometimes it can be longer. But the profits are somewhere between 100 to 1000 pips. So, and it requires little maintenance because once a trade is opened, you just need to monitor it once or twice a day to make sure that the trade is still in profit and the exit criteria has not come up. But it requires a larger stop loss. Like for example, in day trading, you may use a stop loss of 15 to 20 pips, whereas on a swing trading, you may require 50 pips stop loss if you're trading on 1 hour chart, or you may require 150 to 200 pips if you're trading on a daily chart. So the return, the risk to reward is still the same as the day trading. Like for every 15 pips risk, you may expect a 30 pips profit in day trading. Whereas on swing trading, if you risk 100 pips, you may expect a profit of 200 to 250 pips. But again, here the thing is that you should be able to, if someone is doing a swing trading, they should be able to risk 100 to 150 pips. Whereas if someone is day trading, they should be able to sit in front of the computer for significant amount of time so that if any trade opportunity comes, they're in front of the computer to take that particular trade. The other thing is swing trading is the currency pair spread is not important, because when you are, for example, expecting a profit of 200 or 250 pips, you can trade on a currency pair which has, let's say, got a 6 or 7 pip spread, because if you're risking 100 pips on such trade, you can still expect a profit of 193 pips. So currency pair spread is not as significant as is in day trading. Now let's look at the best time frame to trade for any kind of currency pair. On the lower time frame, the best trading opportunities are seen during the first 2 hours of the opening and last 2 hours of closing of a trading market, especially in the native markets. Now what do I mean by native markets? If someone is trading, let's say, currency pair which is based on British Pound, then for them the London session is very important, because most of the activity on British Pound will happen during the London session, because London session has the native currency of British Pound. Similarly, if someone is trading on the USD based currency pair, then for them the America session or the New York session is very important. And again, once the trade is opened, make sure to continuously follow it if you're trading on a lower time frame, and close it when the exit criteria is met. If you're away from the computer, it's better to put a trailing stop loss or a limit order, so that if once you reach, for example, 30 to 35 pips profit, the trade can close automatically and you don't miss out the closing opportunity. Because if you're not in front of your computer and the market reverses, then the profit that you have got from the trade, those profits will be wiped out. In the medium time frame, it can be done at any time. However, checking trading condition at the close of candlestick is important. So for example, now you are trading on a daily chart. It becomes very important for you to check the trading chart once every day to see if there is any trading opportunity present. You should check the chart once the candle is closed, so that you can consider that candle in taking a trading decision. It is suitable for people who cannot or who do not want to spend hours every day in front of or sit in front of the chart for hours every day. Last but not the least, let me cover some points to remember and mistakes to avoid. The lower the time frame, the less reliable the technical indicators are. For example, the technical indicators are more accurate on 1 hour chart than on 15-minute chart. On the other hand, the higher the time frame, the bigger the stop loss you need to use, like I mentioned earlier. So if you're trading on a weekly chart, you need a stop loss of 300 to 400 pips, whereas if you're trading on 15-minute chart, you may need a stop loss of, let's say, 20 or 25 pips. The technical analysis concepts are same across all time frames. The how to plot a support and resistance, for example, the concept of plotting a support or resistance level on a 15-minute chart is the same as the concept of plotting the support and resistance on 1 hour chart, which is the same as plotting the support and resistance on daily chart. The concepts are the same. The candlestick, according to me, is one of the most reliable technical indicators and should be learned by all traders. If you look at the trading charts, by default they are available in the candlestick because it is so widely used. Knowing the candlesticks is one of the most important activities that any trader should carry out. Now, before I end this presentation, I would like to thank you for the time that you have spent in watching this video and giving me an opportunity to share some concepts. So as a free gift for you, I would like to give 2 more highly effective Forex candlestick patterns that work very well with any other technical indicator. I'll also share one candlestick mistake that 50% or more traders make. Perhaps it can be even you and you may not even realize it. And I'm also going to share one highly accurate Forex trading strategy which is based on candlesticks. All you need to do is visit forexcandlestickmagic.com and I'll see you on the other side. Again, the website is forexcandlestickmagic.com. Just visit that site and I'll give you this free package. Thanks again for watching this video, and do share your comments and subscribe to this channel. I keep making the videos and sharing very frequently. So make sure to subscribe the channel and leave your comments. And at the same time, I'll also encourage you to visit my website and where I'll share this free package with you. Thanks again for watching this video.